Most traders think a market bottom appears suddenly. One candle, one signal, one moment where the market magically turns. But that's not how real market reversals happen. Professional traders don't guess the bottom. They observe a process, a sequence of clues the market leaves behind. And once you understand that sequence, the chart starts making much more sense. By the end of this video, you'll understand how markets typically transition from falling to rising and how traders identify that shift without relying on luck. Let's begin with the first stage. Stage 1, selling pressure, begins to fade. Every bottom starts with a strong downtrend. Prices fall quickly, candles are large, fear spreads through the market. But eventually something interesting starts to happen. Even though selling volume remains heavy, price stops falling aggressively. You might see large bearish candles, but they fail to push the market significantly lower. This is often the first clue that selling pressure is losing effectiveness. Think of it like pushing against a heavy door. You keep applying force, but the door barely moves. In market terms, this suggests that someone is absorbing that selling pressure. Large participants, institutions, funds, or large traders, often use panic selling as an opportunity to build positions. They cannot accumulate quietly when the market is calm. But during panic, liquidity is everywhere, which allows large buyers to absorb supply without pushing prices higher immediately. Stage 2. The initial bounce. Once the aggressive selling slows down, price often rebounds slightly. This bounce doesn't necessarily mean buyers suddenly took control. Sometimes the market rises simply because the selling temporarily stops. Imagine holding a ball underwater. The moment you release it, the ball rises, not because something is pulling it upward, but because the downward pressure disappeared. Markets behave the same way, but at this point we still don't know if the bottom is real. So the market performs a test. Stage 3, the retest. After the first bounce, price frequently returns to the previous low. This is one of the most misunderstood moments in trading. Many traders panic when they see the market falling again, but experienced traders watch how the market behaves during the retest. Important questions include: is the selling weaker than before? Are the candles smaller? Is volume lower than the first drop? If the second decline shows less strength than the first, it suggests that sellers are losing momentum. In other words, the market tried to go lower again, but lacked the power to do so. That's a key signal. Stage 4. The base formation. After the retest, markets often move sideways. Price begins forming a range. This stage can be frustrating for impatient traders because nothing dramatic happens. But this quiet phase is extremely important. During this time, larger players often accumulate positions slowly. If they buy too aggressively, they push the price higher and ruin their entry. So instead, accumulation happens gradually. The result is a tight range with decreasing volatility. Stage 5, the false breakdown. Many strong bottoms include one final event, a move that briefly breaks below the support level. This moment often triggers panic. Stops get hit. Short sellers jump in. It looks like the downtrend is continuing. But sometimes the market quickly reverses back above the level. This creates what traders often call a false breakdown. Why does this happen? Because stop-loss orders placed below support become market orders when triggered. When price dips below the level, those orders create a sudden wave of selling. But once those stops are cleared, that forced selling disappears. If buyers absorb it, price can reverse sharply. And when that happens, traders who sold the breakdown often find themselves trapped. Their positions become fuel for the move upward. Stage 6, a change in market structure. After the false breakdown, the next confirmation comes from structure. The market needs to break above a previous lower high. This signals that the downtrend pattern has changed. Instead of forming lower highs and lower lows, the market begins forming higher highs and higher lows. This is often the moment where the market's character shifts. The downtrend weakens, and an uptrend begins to develop. Stage 7. The entry opportunity. Once the market breaks upward, many traders make a mistake. They chase the move immediately, but professional traders often wait. After a strong upward move, price frequently pulls back before continuing. That pullback is where many traders look for entries. If the market finds support during the retracement and begins moving upward again, it can provide a clearer opportunity with defined risk. The role of volume. Throughout this entire process, volume provides important context. Here's a simplified way to interpret it. Early in the decline, volume is often high because panic selling is active. During the retest, volume may decrease, suggesting weaker selling pressure. During accumulation, activity often becomes quieter. And once the reversal begins, rising volume during upward moves can confirm increasing demand. The key idea is simple: effort versus result. If there is heavy effort but little downward movement, selling pressure may be getting absorbed. If small buying effort suddenly produces large upward movement, the path of least resistance may have changed. When the setup fails, no strategy works all the time. There are situations where potential bottoms fail. One major warning sign is when price breaks below support and continues falling without recovering quickly. In that case, the breakdown is likely real. Another warning sign is when the market rallies but then collapses again, breaking the base structure. This tells traders the reversal attempt didn't succeed. That's why risk management is always essential. Even a strong trading idea can fail. Final thoughts. A market bottom is rarely a single signal. It's a series of events. Selling pressure fades. The market tests the lows. A base forms. A false breakdown clears weak positions. Then structure begins to shift. When those pieces start appearing together, the probability of a reversal increases. And understanding that sequence allows traders to move from guessing to analyzing. Because in the end, successful trading isn't about predicting the future. It's about reading the evidence the market provides.